Aloha folks, thank you so much for checking out this video. If you are new to the channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to look at this great company that has been giving dividends for the past 26 years and has a dividend growth streak of 12% the last 5 years. So if that's something you're interested in, and maybe something that you want to put on your watch list or maybe even your portfolio, sit back and enjoy the video. Do me a favor, hit that like button. If you are new to the channel, just wanted to say aloha. Hopefully at the end of this video, I will get your subscription. And don't forget to hit the notification bell. With that said, let's take a look at this company. This company is called NextEra Energy. The ticker symbol is NEE. This is an American energy company, and it's an electrical power and energy infrastructure company. So it engages in generating, transmission, distribution, and sale of electrical engineering and wind and solar. So there is movement towards clean energy. So this is probably one of those companies that will benefit in the next couple of years. So definitely, in my opinion, something for you to kind of check it out. So if you don't know this much about this company, go to their website. You can take a look at it. Some of the key things is top 20 in the world of innovation. They have about 55 billion planned investments in American infrastructure through 2022. So we'll see in the next couple of years these investments. Now if we go over to simply safe dividends, based on their dividend safety score, they rate it as a 99, which is very safe. Their dividend yield is 2.07. The market cap is about 161 billion, which is considered a mega cap. Now, if we go down to some of the key metrics, you can see during the recession, they have increased their dividend. Their payout ratio is about 61%, which is considered low for utilities. Going down a little further to the dividend growth, you can see the last 20 years, 9%. Last 5 years is about 12%, which is very fast, and then the latest is about 10%, which is fast. Now if you see the chart, you can see from 2002 to 2020, you can see a great upward trend. So that's something that I really always look at. And then more importantly, look at that, 26 years of consecutive increases and 26 years without a reduction. So if you're interested in some of the payout details, you can see quarterly in the months of April, June, September, and December. Annual payout will be $1.70 per share. Ex-dividend date is passed away February 28, and then your payout date will be March 15. Looking over to some of the financials, you can see, let's look at the return on investment capital. Pretty low. I would prefer to be around here, so around this area was pretty good. It is pretty low, and then the same thing as the return on equity. Now let's take a quick look at tip ranks. At the time of this video, it's at $81. Their rating is a strong buy based on 12 ratings. You got about 9 buy, 3 holds. Price target is about 93, 14% upside, with the high price target of a 102, average of 93, and the low of 86. Now if we click on the stock analysis, you can see smart score rated as 10, which is outperformed. Inside trading activity, they bought shares in the last 3 months. There's a trend. You can see the fundamentals, and then the tip ranked investors is just positive. Consensus is strong buy, and then you got bullish and bullish. Hedge fund activity has increased. So now looking further to CNN Business, based on their forecast, you can see that in the high of 104, the median of 90, and the low of 79, with the analysis recommendations of 13 buy, 2 outperform, 6 sold, and 0 sells. Now switching over to Yahoo Finance, you can see a little bit more, so you can see the performance outlook long term is bullish. You can see a little bit more on some of the earnings. You can see about beats for the past 4 quarters. Financials, you can see revenue for 2021 is 17 billion, earnings is about 3.5 billion. It has gone down based on the chart. So now if you look at the recommended trends, you can see a mixture based on March holds, strong buy, and a buy. And then the recommendation is a buy. It is lower than the average. Right now the average is about 91. At the time of this video is about 81. Now if we go to this article on the Motley Fool, they talked about 2 top energies to buy right now. This is on March 4, 2022. Now if you go a little bit further, they talked about the 2 ones, which is NextEra Energy and Kinder Morgan, which is KMI. So if you're interested in a little bit more about KMI, just drop it in the comment, let me know. It's a pretty good stock, but if you want me to do a little bit more in-depth analysis of it, let me know. But in this article, if you want to read it, it talks about these 2, and then I'll talk about more of the energy, NextEra Energy. So you could see that in here is on track to grow at a brisk pace in the next few years, powered by its investment in clean energy. The company anticipates delivering double-digit earnings per share growth again in 2022. So a little bit more information. You can see towards the end they talked about which is a better buy. It says here NextEra Energy is pretty much a growth stock, while Kinder Morgan is a kind of stock an income investor would want to earn steady income. So invest some money in both stocks and you can enjoy the best of both worlds. So always make sure you do your due diligence and decide if this is something for you. Again, check this out if you want to learn a little bit more about these 2 stocks, Motley Fool. Now if we go to Google, you can see for the performance the last 5 days, it's been up 6%. The last month, it's up 6%. 6 months, it's been down 4%. Year to date, it's down 10%. For the year, it's up 10%, and then for the 5 years, it's up 152. So you can see the past 5 years, it's been steadily going up. It's been kind of stagnant in here, but I think eventually in the next couple years, it will go up. That would be my opinion. Now, if we move over to BarChart based on their analysis, for the past 3 months, it's pretty much the same moderate buy based on, and the current one is moderate buy based on 9 analysis. Looking at the breakdown, you can see 6 strong buy and 3 holds. Now swing over to Simply Wall Street based on their evaluation, share price versus fair value. They rated this one as 42% overvalued. So currently at the time of this video is about 81. They feel that their fair value is about 57. So that's something that you would probably consider. If you want to wait for a dip, that's you can wait for that. In my opinion, I think it's a pretty good price at this point. But again, make sure you do your due diligence and decide. So again, some of the rewards in there. So you can over here based on snowflake analysis, established dividend payer would provide a proven track record. So here's some of the great parts about this company. Yeah. All right, guys. That's pretty much it. If you please make sure you like and subscribe if you haven't done so. Do me a favor and hit that notification bell if you haven't, and also hit that like button. It really helps the channel grow. Also, if you have Instagram, follow me on Instagram, Mr. Dividend Investor, same name. All right, guys. As always, please remember, stay cool, keep investing, and I'll catch you guys in the next video. All right, take care. Aloha.